Most investors are chasing dividends nowadays, but not many people know about ETFs that are paying just north of 9% right now. And today I want to break down two top ETFs that we're seeing that are all over financial media and really talking about why they pay so much, the risk that associated with them and what no one is talking about, and whether they should have a spot in your portfolio itself. And by the end of this video, you're going to know if these high yield ETFs will fit into you for passive income, or are they really another trap when we look at the dividend and the illusion that it provides? Welcome back to the channel, guys. I am Dennis, your guide for long-term wealth, passive income, and financial confidence in investing to help you control your future. So let's go ahead and get into the breakdown. Now, there's an article over on MSN that talks about two ETFs that are both offering over a 9% yield, which by today's terms, that is extremely high in the marketplace and really poising these two ETFs as the top picks. If you want large monthly or even quarterly dividend checks, they are what you're looking for. Now, the two that we're looking at is the SDIV or the Global X SuperDividend ETF, now yielding a 9.57. When we start looking at rates, when you think of high yield savings accounts, even looking at CDs, 9.57 is a very impressive yield for an ETF, paying it every single month. Now, the expense ratio on this one, a 0.58, so a little bit of a higher rate, but overall, if you're looking about a 0.5 or below, you're pretty much on par with what we're seeing in the ETF world. And this one specifically holds 100 high dividend stocks from around the world. This is not going to tie you to the US markets only. It is going to be in the global markets as well. Now, the second ETF we look at is the DVYE or the iShares Emerging Markets Dividend ETF. The yield on this is a 9.09, so a little bit lower of a yield, and this does pay quarterly, but it does also offer a slightly lower expense ratio at a 0.50, and very similar to our other ETF, holds roughly 100 dividend stocks from emerging markets. So when we talk about that, it really shows some of the emerging markets paying a lot higher return, but with it comes risk. You have to be very and know exactly what you're investing in when we talk about these ETFs, because there often is a much higher risk, really tolerance that has to go with this. Now, the article points out that both these ETFs have a very strong performance this year. SDIV up around 27% this year alone. The DVYE up over 25% this year, which is kind of crazy. So on the surface, super high yield, super strong performance. Sounds like a great combination for an ETF, but let's look deeper into both of these because, of course, what the headlines do not tell you is the wealth that is lost over decades with ETFs like these. So when we start breaking down the why these dividends and why these ETFs look so attractive, it usually comes from a combination of different things, including number one, high risk companies, depression or reduction in those stock prices, very volatile markets, countries with a very unstable economy, and companies are paying out a majority of their earnings versus reinvesting those earnings. Now, when we start thinking bigger picture, when a company is paying a dividend yield, they have the option of either one, paying that dividend yield to their investors, or two, reinvesting that money into the company. So this is where you might miss out on a lot of the growth potential that we could see from a company because they are choosing to give the money back to you. SDIV invests mainly in global high yield stocks, many of which are unstable sectors or could even be in struggling businesses that are looking to raise capital. The DVYE focuses on emerging markets, have a much higher interest rate, weaker possible currency. There could also be political risk within those countries. When you combine these factors, yes, you do get a bigger dividend, but you are also taking a much higher risk. And that's what most investors, when they see these, don't realize in the entirety. So thinking about the hidden risks, let's talk through what we could see with some of these ETFs. That is part that your financial advisor, or if you're investing, might skip in the entirety. But it is the most important part that you need to understand is, again, when it comes to investing, there is a risk associated with it. Risk number one, dividends cut. 9 yield today doesn't mean it's going to be a 9 yield or 9% yield forever, or if they're going to increase the dividend in the future. If a company cuts dividends, which high paying companies actually often do, your income in that ETF is going to drop immediately, depending on the percentage that they actually remove it. Now remember, risk number two, total return may lag. This is where we see a lot of like yield max ETFs. A high yield doesn't mean anything when the prices keep dropping. If your ETF is, let's say, paying you a 9%, yet you lost 15% in the price, you're technically losing money, even though you're getting that monthly income of the 9%. If the ETF goes down in value, you are technically overall losing money. That is why a majority of long-term investors prefer a dividend growth fund than just those high yield dividend funds. But we know over the past 2 or 3 years, the high yield funds have been just booming and have been coming out with options and a lot of different things that we have seen. And of course, comes with a little bit of a higher fee. Like I said, a 0.50, 0.58 for both of these, much higher than something like the VOO, the SCHD. Higher fees can eat into long-term compounding that we see. In addition to that, again, if you're not seeing the growth out of the ETF, that could make a big difference. And the big one that I always shy away from and stay away from, international and currency risk. Emerging markets are very well known for political instability. Currency can fluctuate greatly, inconsistent regulations, and higher volatility. While the 9% return might sound incredible, you could be taking a really big risk in a roller coaster ride, really to get there. And of course, the big one when you look at myself and a lot of you, long-term investing, many companies that have a high yield do not prioritize growth on the other side. Sounds like really good at nice in the moment when you're looking at the appreciation, but long-term capital appreciation will absolutely lack in these ETFs. But of course, there is a sector that it's perfect for when it comes to these ETFs. Who exactly are they right for? It is people who want immediate cash flow, that understand and will accept the volatility we see with these ETFs, not really worried and not using it as a kind of a core holding, and it is to build in a dividend income bucket. When we look at something like this, 3-5% might make sense if you're looking at dividend income, having a little bit more stability with something like, the VTV, the SCHD, a couple other ones, it can really make a big difference. And of course, you should absolutely avoid them if you are a long-term investor. If you're looking for lower fees, really long-term extended results, people who want to set it and forget it, including mine, or anyone who is focused on dividend growth, not just the immediate yield in its entirety. So yes, the SDIV and the DVYE are paying over 9%. That is pretty impressive by any portfolios. But of course, you have to decide when you look at your journey and also your financial plan. Is the risk worth the reward when you start looking at personal goals and when you start thinking about the long-term growth? Now, if you want me to create and really compare some of these ETFs and come up with some safer options, the SCHD, the VYM, the DGRO, VIG, there's a lot that I can break down for you guys if you have additional questions, and definitely let me know in the comments if you do want me to break any of these down. And as always, guys, if you're new to the channel, definitely hit the like button, subscribe to the channel. And if you're looking at building a financial future, staying one step and really being disciplined at a time, guys, I do financial counseling and education. It is something that I love to do and I'm very passionate about. So again, if you like the video, definitely hit that like button, subscribe to the channel if you have not, and I'll catch you in the next video.